in our 2015 series focusing on the Green family, all 4 generations, and all their drama. They have just one life to live, and thankfully they have a guiding light through it all, a trusted team with you, their fee-only financial advisor, and LLIS, the advisor's insurance advisor. Today's presentation will last about 50 minutes, and you'll receive 1 CFP-CE credit if you're logged on for 50 minutes or more. We will process this and send the batch to the CFP board, and you'll receive a confirmation certificate that could take up to about a month. Now, our narrators today know you'll have burning questions, and since these are performed in front of a live audience, feel free to be interactive. Type in your questions, and we'll do our best to answer them timely or at the conclusion of the show. Today's episode is being recorded and will be posted to our website within a week in case you missed a pivotal moment in the story. Today's narrators are experts in their fields of income protection and replacement, peace of mind, and insurance company sweet spots for life and disability insurance. And with 3 kids and 2 kids respectively who've gone through their teen years, they're certainly experts in drama and challenges. So please welcome to the mic Jerry Skapyak and Kathy Bilodeau.
Of our lives. Thank you, Dina, for that. So this year we've been covering the Green family, and this is a photo of them, the family we've been covering. Last month, what you missed was us talking about Carl and Jenny. We went over their disability insurance needs, both individual and supplemental, and also group term insurance and long-term care insurance. So the Green family, you'll notice that names begin with A, B, C, or D for the Green family. Those are the names that begin with anything other than A, B, C, or D have married into the family. This month, we're going to focus on protecting Tony, who married Claire, and their 3 kids, Deidre, Daniel, and David. So here we have Tony and Claire. Tony's 49, Claire's 47. Tony is a home-based IT consultant. Claire is a stay-at-home mom. She manages David's and Daniel's surfing career. And Tony's income's good, but not steady yet. Kids, we have Deidre from Claire's first marriage and David and Daniel from Tony's first marriage also. Now, Andrew, who's the patriarch of the family, suggested they consult with a financial advisor. They had done some dabbling with one many years ago, but he felt it was time for them to address their financial future again. He said, your needs to protect your income and your family, he told them. So, after all, isn't income the foundation of most everything? Without it, how could Tony and Claire and your clients pay for their auto, life, and disability insurance, health, contribute to their retirement plans, savings, investments, or pass anything on to their 3 kids? Andrew convinces them that a fee-only financial advisor is just what they need. So Tony and Claire find a fee-only financial advisor like you to oversee their situation. So what we're going to look at today, and as the financial advisor they're working with, in their comprehensive plan, recognize that they have some needs. They need some term layering for life insurance, term insurance for a non-working spouse. We're going to look at how, as time goes on, some of these best laid plans do need to be modified a little bit. We're also going to look at disability insurance, critical care insurance, and also something new, some specialty lines insurance. So let's take a look at term layering for life insurance. going to take a step back in time, back to when Tony and Claire first got married. Tony had his 2 twin boys, David and Daniel, who were 3, and Claire has her 1 girl, Deidre, who was 5. They meet with a financial advisor about life insurance. And this advisor goes over what are some of the main reasons why young couples should have life insurance. Well, they talked about minor children. He told them you want to make sure you have enough coverage that if something happens to one of you, there's income to help raise these 3 minor children. He also talked about college funding, that even though there may be money to get them, through the years of high school, there still is going to be a need to have some money there to help fund college. He also talked about having money there to pay off the mortgage or to make the mortgage payments. And then also, lastly, he also talked about money being there for retirement. So a study was done where they asked some people what was the cost of a 20-year term, $250,000 level policy for a healthy 30-year-old individual. The consensus of all people asked, they said that the cost for this policy was about $400 a year. For those under 25, they estimated this cost to be $600 a year. And 1 in 4 said the cost was about $1,000 a year, when in actuality, that cost is only $156 a year. So when you look at what are some of the monthly bills that all of us have, you have cell phone bill average for one person is around $61, $64 for cable, $80 for coffee, $140 for takeout lunch, and that life insurance premium is only $113. It can't, or $13 a month. It can't be too hard to convince clients that cutting back just slightly would make getting and affording life insurance a no-brainer. So let's talk about the term layering approach. So the what? What term layering is, it's taking multiple policies and having them match specific needs in a client's life, like getting them to the point where college is funding or the mortgage is paid off or getting them to retirement. It works best with larger policies. We're able to get banded rates with a couple of insurance companies, and also where those policy fees that every life insurance policy has can be waived on some of the policies. As I said, there's 2 companies that offer these multi-policy discounts. So when we're looking at term layering for Tony, as time goes on, Tony's going to earn his income, he's going to save for retirement, and he's going to pay down his mortgage. So basically, the need for future income replacement declines with fewer years of income to replace. I hope that makes sense for everybody. So when we're looking at Tony, we're going to say he's a preferred non-smoker, and he needs $2 million worth of insurance. When he was meeting with that agent, that's what he suggested he needs. So we could look at just a straight $2 million 30-year term, and that annual premium would be $1,700 a year. Or we could look at, well, what if we break this up into 2 policies, kind of meet some of his needs? So if we look at $1 million 25-year term and $1 million 30-year term, his premium is going to be a little bit lower. The premium for the 2 policies would be $1,610. Not that big of a saving. But where we see a big saving is when we really break it out into 3 policies. So here we have Tony's policies. We look at $1 million for 15 years. This is going to get the kids until they are in college. Then we have another $500,000 policy for 20 years, which is going to cover them through those college years. And then a $500,000 policy that covers 30 years. That's going to get them to retirement. So what we do is for the first 15 years, we do have $2 million worth of coverage. Once the kids are in college, we don't quite need as much money, so that policy falls off, and he's left with $1 million. And that $1 million will cover him for the next 10 years. Or I'm sorry, the next 5 years. And then that policy will fall off, and then when the kids are out of college, and then he's left with that $500,000 policy at that point, which will have 10 years left, which will cover him until he reaches retirement. Now you can see the annual premium for just the 20-year or 30-year term was $1,700, or if we did that 25 and 30-year, $1 million each, the premium was $1,610. But when we do this layering where we're breaking out the 3 policies, we actually have more substantial savings. We're saving about 28 to 32%, depending on which company we go with. So here we have some actual real savings for the client. And then what's great with this is that in 15 years, that $1 million policy falls off, and now he doesn't have to pay that $420 or $390 a year. And then in another 5 years, the other policy falls off. So saving them even more money. So we talked about the term layering. Now let's take a look at covering Claire. She's a non-working spouse. She doesn't, in theoretical sense, doesn't go to work, but she is a stay-at-home mom. In fact, what is a stay-at-home mom worth? You know, there was a study done that if a family had to hire someone to do everything the stay-at-home mom does, that it would take about $118,000 to cover that. You know, she's the facilities manager, the housekeeper, the chef, the tutor, the chauffeur, just highlighting some of what she does. Stay-at-home moms do quite a bit. I know I personally would not want that job. I'm happy that I'm able to go into an office every day. So for Claire, when they first got married, it was determined that she needed $1 million a 15-year term. When we're looking at providing coverage for non-working spouses, typically we can match a working partner's coverage dollar for dollar up to $1 million. Getting any more than $1 million of coverage for a non-working spouse can be a little bit tricky. We'll need a little bit more information. The insurance company's going to look more at the assets. They're going to look more at how much coverage the working spouse has to justify anything over $1 million. But this $1 million for 15 years is going to cover Claire until the kids are in college, and then it's going to do it for a small premium, only $284 a year, to ensure that if something happens to Claire, that Tony isn't going to have to miss work to do a lot of those things that Claire would have been able to do. So now we're going to take a look at modifying term needs. Now we're going to fast forward today with Tony and Claire. Tony's 49. He's been earning about $100,000 a year, but now he's an IT has an IT contract with Flying Carpets, and he's making about $150,000 a year. So his income has increased quite a bit. Claire really is no longer the stay-at-home mom, but now she's actually traveling with the boys, managing their surfing career. So here we have Deidre, who now is 22 years old. She completed her 4-year degree, but you know what? She went, Mom and Dad, I think I want to be a veterinarian, so I'm going to go to school for another 4 years. And then David and Daniel, who are both 20, they're professional surfers, so they've decided they're going to put off college for now. They want to keep pursuing their surfing career. So Tony, when he meets with you, determined that his needs have kind of changed a little bit with the insurance. He's still going to be working about 16 more years, so he needs income replacement still. The kids are going to be in college for at least another 4 years, and he's got mortgage payments for another 20 years. So his needs have changed. His current coverage is, you know, he's got about 3 years left on that $1 million policy, and then 18 years left on the 2 $500,000 policies. But meeting with the financial advisor, the current needs are still about $1.5 million for another 20 years. So what does Tony do? Well, what we're going to do for Tony is we're going to replace that $1 million policy that only has 3 years left on it. We're going to keep his 2 $500,000 policies because we've still got about 8 or 18 years left on it, and then we're going to add a new $500,000 policy for 20 years. So this is going to now cover, the kids to be out of college. It's going to cover that mortgage and that income replacement. But Claire, her current coverage is $100,000, or I'm sorry, is $1 million for 3 years, but she still needs $1 million for another 10 years. And what that would do is that's going to allow her to, to keep managing the boys, and that if something happens to her, the boys will be able to hire a manager to replace her to help manage their careers. So what we do is we're going to recommend that she gets a new $1 million policy for 10 years. So at this point, I'm going to turn it over to Kathy, who's going to talk about some disability insurance.
Thank you, Jerry. Well, Jerry talked about the need for life insurance protection. Now, I'm going to talk about the different types of protection available for Tony, Claire, Deidre, and Daniel. As Jerry went over, the most valuable asset for your clients is their income. And as he mentioned, if the income is what is used to pay the auto, home insurance, the life insurance, and most importantly, the disability insurance, because if something should happen to your client's income, everything falls away. But if they had a disability insurance policy, they'd be able to pay their life insurance, their home, their auto, their health, and be able to put money into their retirement and pass their assets on. So as Jerry mentioned, we have Tony and Claire. Tony's 49, Claire's 47. And as we went over in his presentation, we have a situation where Tony's income is good and it's getting much better. And he's got kids and she's got kids from a previous marriage. The problem is that the advisor has figured out that the first priority should be protecting Tony's income. And the reason for that is Tony is the sole income earner for the family. And if something should happen to him, his entire financial plan falls to pieces. So the first thing that we're going to look at is how do we get Tony covered for disability? Well, the first thing that we're going to look at is what determines eligibility. The first thing is going to be Tony's ability to earn an income. Well, he does have income, and insurance companies not only look at income as a base and a bonus, but they'll also look at commissions. The next thing they look at is their occupation. Is the client an executive at an electrical company, or is he an actual lineman? And the last thing they look at is health. Now, let's talk about your client's health. If they look at, when you look at life insurance, like Jerry was talking about, insurance companies are looking at mortality. But with disability, they're looking at morbidity. The difference between the two is life insurance, they're concerned about something prematurely causing the death of your client. With disability, they're concerned about an illness or a sickness that might cause your client to go out on claim. So if your client has a back issue, that's really not going to be a problem for life insurance, but it could be for health insurance, or excuse me, for disability insurance. So let's look at the financial underwriting. The first thing that they look at is what we talked about just a minute ago, is the earned income. The second piece to that is unearned income. The most common one that I see is net rental income or investment income. The reason that they look at the unearned income is because this income will continue to flow to the client in the event that they become disabled. So what the effect that it has is it will limit the benefit that's available to the client when we're underwriting for disability. So some of the things that they look at for financial underwriting, because you have to remember, when you're applying for disability, your client is going to not only be medically underwritten, but they're going to be financially underwritten. So while an underwriter might look at medical records and lab results for the medical portion, they're going to need to look at tax returns, W-2s, year-to-date pay stubs, which is probably the most prevalent thing at this particular time of the year, since we're almost into December. And in Tony's case, they're going to look at that contract that he has with Flying Carpet. And just to let your clients know, when we conclude the entire underwriting process, we do shred all their financial information. And in the interim, when they're going through the underwriting process, it is kept confidential. So LLIS is almost always shows disability plans that are non-cancelable and guaranteed renewable. And that simply means that the premiums cannot be increased and the policy cannot be canceled for any reason unless your client doesn't pay the premium. So typically what we see is a base monthly benefit. You're going to see an elimination period, and this is the time when the client self-insures. And we traditionally use a 90-day elimination period simply because most of the advisors that we work with recommend that their clients have at least 90 days of emergency cash available. The second feature that we look at is the benefit period. Most of the time we use age 65, which is pretty much the norm for Social Security retirement, but more and more insurance companies are looking at 67 and actually to age 70 as a possible benefit period. And then riders, we have the future increase option rider, the residual rider, the cost of living adjustment rider, and the catastrophic rider. So let's look at the individual riders a little more closely. The first one is the future increase option rider. This is the rider that allows your clients to increase their monthly benefit as their income goes up. So in other words, if their income goes up because they've had a pay increase, or they've had a bonus, or an increase in commissions, or perhaps they've changed jobs and now they're making more, this is an opportunity for them to increase the monthly benefit with no medical underwriting, simply that financial underwriting that we talked about earlier. The next rider is the residual rider. This is the rider that allows your client to work on a part-time basis if they didn't fully recover from their disability. So depending upon the carrier, they can have a loss of 15 to 20% of their prior year earnings before they went out on disability and would be eligible for the residual benefit. Now the cost of living adjustment rider that we traditionally use is a 3 to 10% compounding percentage. And again, this one's just going to depend upon, what the consumer price index is for that particular year. And then the last rider, the catastrophic rider, this is the one that pays on top of the base monthly benefit, and it could almost equal 100% of your client's earnings. There's actually 2 to 3 triggers, but most companies will offer the 3 triggers. An example would be a loss of activities of daily living, 2 or more of those. Another example is if your client suffers a cognitive brain impairment. And then last, if they lose the use of arms and legs or the ability to speak, vision out of both ears, vision out of both eyes, hearing out of both ears, any of those would be a trigger. So let's step back in time when Tony and Claire were just married. So here we have Tony, brand new IT consultant. He's 26 years old. He landed a great job at a software company earning $30,000. And his advisor at the time had mentioned to him, after he'd been working there about 8 years, that maybe he need to look at a supplemental disability plan. So the reason for that is simply because the reason for that is simply because he thought that the group coverage wouldn't be sufficient enough. And because Tony jumped around a lot from one company to the next, he thought this would be a nice safety net in case the company that he went to work for doesn't have any type of group disability benefits. And that was really important for him to do that. So what we did is we got him a $1,500 a month benefit. We put the residual rider on there. We put the COLA rider on there. And because he's going to be making so much more money in the future, we thought it was important to have the future increase option of $1,500. And because he did jump around a lot and he did make more money, he was able to increase his monthly benefit from the $1,500 to the $3,000. So this is really important in case your client does end up working for an employer who doesn't have disability benefits. They can always access that future increase option rider. And the premium for this particular plan was $470 a year. That's not very much premium, and that's simply because he's male and he's young. He's 26. Now let's fast forward to today when Tony is a 49-year-old IT consultant. And remember, he landed that contract with Flying Carpet. And for those of you who tuned in July, we talked a lot about the Flying Carpet. And now that he's making $150,000, his advisor thought that it might be a wise idea to look to see if he's got enough disability coverage. So what we did is, and doesn't he look really cool with those Google glasses on? So what we did is we decided to supplement his income by another $2,650, and we put a residual rider on there, the COLA. This time we put the catastrophic rider on there for $5,000, and we upped that future increase option rider to $12,850. And the premium for this is just under $3,000 a year. So you may have clients who can't qualify for disability insurance or who need additional coverage. Critical care insurance was designed as an alternative and also as an add-on to traditional disability insurance. Now, since Claire is not officially employed, even though she does manage the boys' surfing career, she's not eligible for disability coverage. So we thought a critical care plan would put Tony's mind at ease if something were to happen to her. The catastrophic plan provides them with a lump sum benefit and no elimination period. So let's talk about critical care insurance in greater detail. Critical care insurance is ideal if your client's not covered by disability, or perhaps they're maxed out on their disability coverage and they can't get any more. It's great for people who might be self-employed, such as Tony even, or working from home. People that are realtors or who have an erratic income. They could be retirees. And the nice thing about the critical care is it was designed back in the 80s. And so it's been around for a while, even though some people might not have heard about it. But critical care was designed by Dr. Christian Bernard, who is a heart transplant surgeon over in South Africa. And he would perform surgery on his patients, and they would do very, very well after the surgery. But shortly thereafter, they wouldn't thrive. And the reason is they were so concerned about paying off all the medical bills from the transplant surgery. So this is how critical care insurance came about. It's a way to have a lump sum of money in case most of the major issues are a heart attack, stroke, or cancer. So this money is available to your client in the event that they have all these medical bills. They can use the money to pay for lots of different things, and we're going to talk about that next. But before we do, I wanted to mention that today 4,000 Americans will hear you have cancer. 2,100 Americans will have a heart attack, and 2,000 Americans will have a stroke. But guess what? If they had a critical care policy, they would have gotten a check. Every 34 seconds, someone suffers a heart attack. Every 40 seconds, someone suffers a stroke. Again, if they had a critical care policy, they would have gotten a check. Unfortunately, critical illnesses don't discriminate, and as a matter of fact, critical care coverage has gone from a blue collar to a gray collar and now a white collar product. Studies show that the higher the education level people have, the better they'll take care of themselves. The lower the education level, healthcare becomes less of a priority and there's less knowledge about it. So when you look at critical care insurance, the issue ages are 18 to 64. You can get a benefit period from 10 years all the way up to lifetime, and the average is what we use is 20 years. You can choose a benefit amount from $10,000 to $1 million. And these are some examples of what a critical care policy would pay in certain illnesses that would come up. So, like I mentioned before, cancer, heart attack, and stroke. But you can see if your client has major burns or an organ transplant, similar to the loss of activities of daily living on a long-term care policy, it would pay for that, and so many more other than what are here. And critical care insurance doesn't care what you do with the money. So when you get that lump sum of money, your clients can use it to pay off their mortgage, their car, credit cards, utilities, child care, groceries, medical costs. You can use it to pay those high deductibles, those co-payments. If your client was working and he's no longer working, it could help offset those lost wages. Now, some of you might be asking yourself, how do I determine the right amount of coverage? Well, every situation is different, but here's a typical equation that we use in order to help determine the right amount. First, you're going to take your client's monthly mortgage for 24 months, their typical living expenses for 24 months, then you add in an average about $5,000 for miscellaneous medical expenses that are not covered by health insurance. And that's usually a nice number for what your client might need. Might not be perfect, but at least it's a starting point. So what we did is we looked at Claire, again, because she's not eligible for disability insurance, and at 47, we determined that a lifetime benefit period would probably be the best for her. Now, there could be a max benefit amount of $100,000 or $75,000. Those were the two that the advisor asked us for. And the premium for the $100,000 would be about $1,100 a year or $92 a month. And the $75,000 benefit would be about $957 a year or $80 a month. How does it work? Well, here's an example of how critical care insurance works. A critical care insurance policy will help your client pay will help them pay various bills that might come in. So here is the $100,000 critical care. She suffers a stroke and she's hospitalized. Boom. She gets critical care policy, pays her $100,000 lump sum benefit. And she uses that money after she gets out of the hospital to pay speech and physical therapy expenses. It will replace lost income of time not working in addition to their group disability if they have it. Okay, I'll do it at the end. The beauty of it is it can pay again. So in this instance, if Claire had her $100,000 policy, and let's say she suffers a heart attack and a year later is hospitalized, guess what? Boom, she gets another $100,000 of benefits. And she can use this money, again, when she gets discharged from the hospital, for cardiac rehab. Oh, let me try that again. And as a sideline to that, this will actually pay a third time. So God forbid if Claire was diagnosed with some sort of cancer, she would also get another $100,000. So that's the beauty of a critical care plan. It can actually pay 3 times, and you're only paying the premium for one $100,000 benefit. Now we've taken care of Tony and Claire. What about David and Daniel, who are all over the world with their surfing careers? We had a number of your clients throughout the years who have been unable to get approved for disability insurance due to their occupation, their income, or their health. I don't like to tell you or your clients no that we can't help them with any situation. So we started investigating different options for them. Some of these are called specialty lines, and we've been recommending them for years. But there's one that's so new, exciting, and I'll be getting to that in just a few slides. But first, let's look at our Lloyd's of London plan. Now, you may come across clients who have unusual occupations or, like I mentioned earlier, extreme high wage earners who require special solutions. So we want you to be aware of these specialty lines and not forget that we do offer Lloyd's of London. Lloyd's of London, like I said, is for atypical occupations or income, but the difference between this type of plan and your traditional disability plan is it has a limited benefit period. Traditionally, it's like 3 to 5 years. It has renewable underwriting. So after 5 years, you have to actually purchase a new plan and be fully underwritten all over again. It has specific occupation language. So if you have a physician or a surgeon that you want to make sure if he can't perform surgery that this disability benefit would pay, we can certainly make sure that language is included in the policy. And the monthly benefits can exceed a traditional disability. As you know, there's issue and participation limits with disability carriers. We can go above and beyond those. And then lastly, age. Most disability policies, you can't get insurance beyond age 64. This one we can actually get you covered beyond that age. So many of your clients like this who we've helped include physicians, athletes, international banking executives, high-level attorneys. But for now, let's look at our twin surfers. We have David, who's doing a little bit better than Daniel. He's the more photogenic of the two, and he's got a lot more money coming in through endorsements. So we needed to make sure he had a higher benefit amount. So with David, we gave him a $500 lump sum, and there's a 12-month elimination period and a $20,000 annual premium. With Daniel, because his endorsements are not generating the same amount of income, we got him a $250,000 benefit with a $10,000 annual premium. And while these premiums may seem high, you have to look at their income. These premiums are only about 4% of their annual income, and we're protecting their income in a profession with a high likelihood of injury. It takes a lot for us with normal occupations to be out of work. If you or I twisted a knee, we'd be back to work, and that happened to me in July. I still made it in, never missed a day of work. But David or Daniel, if they get a twisted knee, they're out on claim. There's no way that they're going to be able to participate in a surfing event. So The next solution that we have for your clients in the disability arena is one that I'm really excited to share with you. It's called the Accident Choice Plus plan. The Accident Choice Plus plan is a medical reimbursement plan. The way it works is it reimburses your client for any expenses that they've incurred, whether their insurance company, their health insurance company, I mean, or whether they've paid for it out of their pocket. For example, if your client goes to the emergency room or to an urgent care, any bills that they incur there, either through the physician, either through surgery, x-rays, any kind of tests, whether it be an MRI, CT, EEG, any drugs that are administered, any type of physical therapy that they might need, even if they had to take an ambulance to the emergency room, these would all be reimbursed. Now, who would benefit from this? Any non-working or working client, any of your clients who have a high deductible plan, or any clients that don't have any medical coverage at all, or your clients who are hard to underwrite. Maybe they're unhealthy or they have unusual occupations. Now, the policy is guaranteed issue, which means nobody gets turned down. The issue ages are 0 to 64, and the reason for that is because it does cover family members, hence the reason that it goes down to age 0. It is age-banded, and the rates are unisex. You can choose a benefit period from $5,000 to $25,000, and you have a choice of a deductible between $100, $300, and $500. And as I mentioned before, it's dollar for dollar medical reimbursement up to the benefit maximum per calendar year. So in other words, if you choose $25,000, you can use $25,000 worth of expenses, and then the following year it resets itself and you have another $25,000 available. So it's kind of like a pool of money. There's no waiting period, so there's not an elimination period that you have to satisfy. And there are riders that are attached to it if you think that your client would benefit from those. The first one is a critical illness rider. That would pay a lump sum of $5,000 to $50,000 if your client had either a heart attack, stroke, or was diagnosed with cancer. It also has an accidental death and dismemberment rider. And then lastly, the accidental disability income rider. This is the one that if your client were to be unable to go to work simply because of the accident that had occurred, they'd be able to collect $500 to $2,500 a month for 6 months after a 14-day elimination period. So what we thought that an appropriate plan would be for Deidre, because Deidre, as you know, has decided to go on to veterinary school, and she's going to be working in a zoo. So we figured
tigers and bears, oh my!
that there would be a greater likelihood of her getting injured while working in a zoo. So we planned for a $15,000 benefit for her with a $500 deductible, and because she is working at the zoo, she does have an income, we attached the accidental disability income rider. So if she were to become disabled due to an accident, she would get $1,000 a month for 6 months, and the premium on this plan is $762 a year. Then we thought, would this be a good thing for Claire? Well, let's see. So with Claire, we decided to do the exact same plan for her, but instead of the accidental disability income rider, since she doesn't have an income, we put that critical illness rider on there for $15,000. And again, that's a lump sum, and it covers regardless whether her health insurance covered it or not. And she would get that at the diagnosis of a heart attack, stroke, or cancer. And the premium for her plan is $486 a year. Now, we also considered Deidre for a new professionals program. The new professionals program is a program that was designed for those young individuals who are just starting out in various occupations where they're not going to be making very much money right now, but once they launch, they'll be making hundreds of thousands of dollars. So it allows them to lock into a policy now and protect their health and to protect their income while they're still in training. And you can see by the list here, the program is ideal for your clients who are 20 to 30-something. And it's available to clients whose income doesn't even get considered. So in other words, if your client is a student, is a resident, or a fellow, they don't even consider what the income is. It's just a set dollar amount or a set monthly benefit that's available to them. There is medical underwriting that they have to undergo, though. The other thing that's great about this feature is their group coverage is not considered. So if they're a resident and they're working at a hospital and they have group coverage available to them, they don't even factor that in. It's automatically the set dollar amount, whatever it might be. And in a minute, we'll see what those dollar amounts might be. And the other feature that you could have on this program is the graded premium option. The graded premium option gives them a full disability benefit plan with all the features, but it has a lower premium that goes up little by little every year. And the thought process to this is once they launch and they're making a lot more money, we can convert that premium from a graded premium to a level premium. Now the sizzle with this program is that during the time these professionals are still students or residents or fellows, their income and group coverage is not factored in. But once the client becomes a physician or is in their first year of practice, the group insurance can limit the benefit amount available to them if they have group insurance at their new position. So here's a sample of some benefits available to the various professions. And this is the one for Deidre because she's a veterinarian, and she would have $2,000 to $4,000 available to her. Now you might be asking yourself, why are there different numbers for the different occupations? Why have one and some have a range? And the reason for that is depending upon what the occupation is, they might still be a student, or they might be a resident, or they might be a fellow, or they might be in their first year of practice. It just depends upon the nature of the profession. So with Deidre being a vet/resident and age 22, we were able to get her a $2,000 a month disability benefit. And because she's going to school for a very specific occupation, i.e. being a veterinarian, we thought it was important that we make sure that she has that own occupation definition built into the plan. And because she's not making very much money right now, we thought that maybe the graded premium would be a little bit more affordable. So that's $334 a year. Now, if we put some of those riders on that we talked about earlier, the FIO at $4,000, the residual, COLA, and CAT, her premium goes up a couple $100, $540 for the graded premium. So this month we covered not this, although I wish, and certainly not this, and thankfully not this kind of green, but instead we covered these greens. We covered term layering life insurance with Jerry. We also talked about term insurance for non-working spouses. We talked about modifying term needs as your clients age. And we talked about covering your clients for disability insurance. And if your clients aren't eligible for disability insurance, perhaps critical care insurance or one of our specialty lines would be a nice option. Do I do this with questions? When do we do the questions? Keep going. Okay, sorry. So tune in next month to find out what really happened to Ben. Did he die or dun, 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 dun? And when Carl is forced out of flying carpet in a hostile takeover by Kelly and forced to retire early, what will be done about his pension? Did you know that LLIS is presenting the Genesis webinar on November 18th by none other than WA? So make sure you tune in. And we'll be doing an XYP on webinar on December 2nd. And lastly, we'll be doing our Garrett member webinar on December 11th. Now keep in mind that registration is now open for the Walk the Walk, which is LLIS's Academy for 2016. Now you could be in this type of weather in February. Or you could be with us in beautiful Tampa.
Fun and fantastic. Riverwalk passes in front of something for everybody. Hotels with outdoor lounges, boat docks, river cruises, and vistas of local history.
Okay. Top 10 things that make LLIS different? Well, make sure you tune in to our free monthly webinar. Next month is How Insurance Minimized the Family's Risks. Top 10 things that make LLIS different? Well, we're not your competition. Our clients are only fee-only advisors. We save both you and your clients money and time. We pre-underwrite to avoid surprises, and we provide tools for you and your clients. We also proudly sponsor NAPFA, NAPFA Genesis, XY Planning Network, the Garrett Planning Network, and Alliance of Comprehensive Planners. We have proud specialists in life, disability, woohoo, me, long-term care, annuities, woohoo, Jerry, and hybrids. When your clients get insurance through us, we keep you in the loop with our AIM system. And we manage your clients' policies both now and in the future with our APE and our note systems. Questions. The first question I have is, are the critical care insurance benefits taxable income? No, because you're paying for the premium with after-tax dollars. Can you review the non-working spouse? A non-working spouse, I'm not quite sure what you mean by specifically Jerry's presentation about insuring for life insurance or for critical care or the accident plan. I don't know what the percentage of the population is covered by critical care. That's something I'd have to research. Can clients with an existing condition get critical care insurance, for example, a stroke but fully recovered? I believe so. It's going to depend upon the company. Can you review, oh, insurance for her, you missed the slide. Okay, so hang on a minute. Okay, how do I do that? Okay, so here's the critical care, which would be the product for a non-working spouse. Issue ages are 18 to 64. A benefit period can go from 10 years to lifetime. The benefit amount can be $10,000 to $1 million. And these are examples of typical covered conditions, and there's lots more. It's a lump sum, so the money can be used for whatever the needs are of your particular client. These are just a sampling of what you can use the money for. This is how you determine the monthly benefit or the lump sum benefit. You take the monthly mortgage for 24 months and the living expenses. You add in another $5,000 of medical expenses that probably weren't covered by the health insurance, and that would give you the amount that's needed. And it pays for mostly for heart attack, stroke, or cancer. Let me know if that was enough for you. Okay, good, Wendy. Underwriting requirements for critical care insurance. I have a 28-year-old client, 5-year past kidney transplant, just graduated from pharmacy school. Could she qualify? That one I'd have to run up to an underwriter because that's very specific, but we could certainly take a look at it. I can make sure that Dina gets this question and I can address it tomorrow. Anything else? I answered that already, yeah.
Thank you, Kathy. We have a question about some of the term insurance I went over, more specifically about delayer and about how do advisors go about requesting that with us. On our quote request, when you're completing or the clients are completing it, you'll see that you can put in multiple amounts of coverage. So you guys, I believe you can put up to 4 different face amounts. And you can select the different term periods. So if you have, or you just have the client do that, and then also just put a note somewhere in the quote in one of the open text fields, just say you would like to see it as a term layer, we will send those quotes out like that. I hope that answers your question. Is there any other questions that we can answer for everybody that's here today? Give it another minute. Okay, question came in, is it only the 2 companies that offer the term layer? There is only the 2 companies that offer a discount for doing the term layer, but that doesn't always mean that those 2 companies end up being the least expensive. Sometimes depending on the underwriting for that client, it may not be beneficial to go with one of those companies, so we may go with another company that maybe it doesn't have a program where they're going to do banding for all the policies or offer to waive some of the policy factors, but because they may have better underwriting for that client, their premiums will ultimately be lower than if we went with one of the companies that does have the actual term layer programs. All right, I don't see any more questions. Thank you, everybody, and have a great evening.